But then we have a drawdown that feels like a bear market.
If you own Nvidia stock, this is the warning you need to hear. Tom Lee, one of Wall Street's most respected strategists, just warned that 2026 will start strong, but then something massive is coming. A shockwave that feels like a bear market. And if you think Nvidia is immune to that correction, you're making a dangerous mistake.
You have Microsoft down 12, Meta up 10. These names generally, obviously, move in the same direction. We've literally never seen a day like today.
On the same earnings night, Meta surged 10% while Microsoft crashed 12%. For Nvidia shareholders, this should terrify you, because Nvidia's entire bull case depends on companies like Microsoft and Google spending trillions on AI infrastructure. But what happens when those customers start pulling back? Based on the information Tom Lee gave us, there's a specific way to protect your Nvidia position if this correction hits. I'll walk you through it shortly. Nvidia has been the story of the bull market, the stock that everyone wanted, the company that couldn't do wrong. But here's what most Nvidia shareholders don't understand. Nvidia's growth is completely dependent on its customers continuing to spend money at a maniacal pace. Those customers are Microsoft, Google, Amazon, Meta. And what we're seeing right now is a fundamental crack in that narrative.
The correction is happening under the surface. So Oracle, as I mentioned, cut in half. This is the Mag 7. Microsoft's in a bear market, Tesla's 14, Apple's down 10.
Oracle is down 51%. Microsoft is in a bear market. These are Nvidia's biggest customers, the companies that are supposed to keep ordering chips forever. And they're getting absolutely destroyed. For Nvidia shareholders, that's the first red flag. When your biggest customers are breaking down, it's only a matter of time before their capex budgets get questioned, and that's when the chip orders dry up.
You see the big tech correlation. So we're looking at it, the rolling 6 months, and it's crashing. So like today's a great example.
For years, Nvidia moved with the rest of big tech, all up together, all down together, but that correlation is breaking apart, and Nvidia shareholders need to understand what that means. The market is no longer giving free passes just because you're a mega cap tech name. It's asking harder questions now. Is your business sustainable? Are your customers going to keep spending? Or are they about to get crushed? Here's what scares Wall Street about Nvidia right now. Artificial intelligence spending might not create the returns that everyone expects. Nvidia's entire bull case is built on the assumption that companies will keep spending trillions on AI chips because AI will generate massive returns. But what if it doesn't? What if all those chips sitting in data centers are generating less value than expected?
You're thinking about AI as a bull, you just told us. It's wreaking havoc on the stock market right now. It's not the AI theme, if anything, is erasing market cap, not adding it, at least in software stocks.
This is the part that Nvidia shareholders are missing. The AI narrative isn't adding market cap to tech stocks. It's erasing it. Why? Because artificial intelligence is destroying the very business models of software companies. If AI can write code and replace subscription services, why would anyone need those companies anymore? And if those software companies are doomed, what does that mean for the data centers filled with Nvidia chips that were supposed to make those companies rich?
But it's actually declined. It's like one of the few industries where there's fewer people.
Remember they said to everyone, learn to code?
Yeah.
Not great advice. Learn art history.
Tech employment is actually declining. Fewer people are working in tech right now than before. That's the opposite of what you'd expect if AI spending was supposed to create a boom. Instead, AI is destroying jobs faster than it's creating new ones. And if tech companies are laying people off and cutting headcount, guess what happens next? Capex budgets get cut. And Capex budgets are where Nvidia sells its chips.
In Azure, down from 39%.
Yeah.
And the market's like, all right, we'll take $400 billion, please. Thank you very much.
Microsoft just cut Azure growth guidance from 39% to 38%. That's 1 percentage point, and the market demolished the stock for it. Now think about what that means for Nvidia. If Microsoft, one of Nvidia's biggest customers, is slowing down chip orders, what does that say about the strength of the AI spending cycle? It says the cycle is peaking, and when growth cycles peak, they usually turn down hard. The entire software industry is being decimated right now. IGV is down 25%, Workday, Service, Now, Salesforce, all in freefall, and this matters for Nvidia because these companies were supposed to be the ones generating returns on all those AI chip investments. Yeah, if the software companies are dying, who's going to generate the returns that justify all this chip spending?
So ServiceNow had great earnings. Stock is mauled, and it was already getting destroyed.
Okay, so that's also a bad sign.
It's very bearish.
If you go down on good news, it's a bad sign.
Service now reported great earnings. The stock got absolutely mauled. When good news doesn't move a stock higher, it means the market has made a decision. This industry is dying. And if the software industry is dying, the demand for the chips that power AI in software is also dying. For Nvidia shareholders, this is the canary in the coal mine. Here's the uncomfortable truth. A huge portion of Nvidia's gains have been fueled by margin debt, borrowed money. Nvidia is one of the most popular stocks for leveraged traders. People are buying Nvidia with borrowed money, and right now, that margin debt is at a critical threshold.
The year-over-year change, it's actually positive for stocks until the percentage gain exceeds 38%.
The percentage gain of the margin debt itself.
Yeah.
We're there.
Yeah, it's at 36 right now.
Margin debt year-over-year growth is at 36%. That's almost at the critical 38% threshold where historical data shows forward returns flip negative, and Nvidia is one of the stocks where this borrowed money has been concentrated. When that leverage gets unwound, and it will, the selling in Nvidia could be vicious, because leveraged traders don't sell slowly. They get forced out, they get margin called, and then it becomes a cascade. The correlation between megacap tech stocks is breaking. That's happening partly because traders are rotating out of the expensive names like Nvidia and into cheaper, beaten down stocks. That rotation will accelerate if the market corrects. And Nvidia, being one of the most expensive megacaps, will be one of the first names to get hit in a rotation like that. Here's something really important that Nvidia shareholders are missing. The market is broadening out. Smaller stocks and international stocks are starting to outperform. That's usually a sign that traders are getting nervous about megacap valuations.
Well, the S&P cap weight has turned sideways, and you're seeing a breakout in the 493. I love it.
The equal weight S&P 500 is breaking out while the market cap weighted S&P is turning sideways. That means money is rotating away from the mega caps, the Apples, the Microsofts, the Nvidias, and into smaller stocks. For Nvidia shareholders, that rotation could be the beginning of a much larger move lower. So now you understand the threat, you understand why Nvidia shareholders should be concerned, you understand that a correction is coming. Microsoft is cutting guidance, software companies are dying, margin debt is at the danger zone, the correlation is breaking. But the real question is, what do you do with this information? Because knowing about the risk and actually protecting yourself are two completely different things.
There are some signs of stress in the economy now because of high rates, whether it's consumer or private credit. And we know valuations are more expensive because we have 3 years of gains.
Tom Lee expects a market that looks similar to 2025. Strong start, then a significant drawdown. For Nvidia shareholders who bought near the highs, that drawdown could wipe out years of gains.
I think that this is the year where we've seen more policy shocks coming. I think the White House is being more aggressive.
But here's what most investors get wrong. A correction doesn't have to mean panic selling. It doesn't have to mean buying at the bottom. There's a specific strategy that professional investors use to navigate exactly this kind of situation, and I'm about to show it to you. Tom Lee still believes in the long-term bull market, but he's warning about a significant correction mid-year. From current levels, that could mean a 20% drawdown, and for a stock like Nvidia, which is more volatile than the broader market, that could easily translate to a 30 or 40% decline. The question is, what will you do when it happens? The smart move for Nvidia shareholders isn't to panic sell, it's to understand the risks you're actually underwriting. Your returns hinge on 3 pillars. First, that giants like Microsoft and Google keep pouring massive sustained capital into AI chips. Second, that software companies can turn all that AI spending into real profits instead of just impressive demos. And third, that the market forces powering Nvidia's run, crowded positioning, leverage, and elevated valuations, don't suddenly unwind. As long as those pillars hold, Nvidia can keep working. But if even one starts to crack, the stock can drop hard without Nvidia doing anything wrong operationally. Any one of those 3 things breaking could send Nvidia down 30 to 50%. And right now, all 3 are at risk.